Hello everyone. Many people think stock investment is risky. Yes, to a certain extent it is true. But at the same time, if you look at the richest people around us, they either have their own business or they have great stock portfolio. So realizing this, many people have started investing in stock market after COVID-19. But till last year, Indian market went only on one side, up. They really didn't realize that there could be big corrections. And last 6 months, I know everything has changed. Retail investors' portfolio started bleeding. The main reason for this is the way that they have constructed portfolio. In this video, we are going to discuss the fundamental mistake every retail investor makes or have made in the last few years in the direct stock investment. So if you have invested directly in the stocks or planning to invest in stock, this is a must-watch video for you. I'm sure you're going to learn important lessons. So stay tuned till the end. If you are new to this channel, I'm Keerthi. I run the consultancy, a firm which is specialized in NRI services. Based in Dubai, we offer NRI investing, finance, tax and FIMA services. If you are interested to avail any of our services, please feel free to book an appointment by visiting www.keerthisfinfo.com or contact this number through WhatsApp. If you don't know me, I'm CS from India and Seema from UK and also SEBI registered overseas MFT. Every week, I bring you and explain a video on various NRI related issues, be it tax or finance or investment. If you are interested in any of these topics, you know what to do. Please consider subscribing this channel. In today's video, I want to explore 7 most critical mistakes I have personally seen investors making repeatedly in the stock market investing. These mistakes have costed people hard-earned money and time also. So my goal is to help you avoid these pitfalls. So without delay, let's start with the first mistake. That's trading in FNO or futures and options, that too without knowledge. When people say I've lost money in stock market, usually they would have tried FNO. So it comes under derivative category. Derivatives trading is often marketed as a way to make quick money with small capital by brokerage companies. But it is actually a complex field that requires deep understanding of market mechanics, options and risk management strategies. The leverage, especially in F&O, can multiply your losses far beyond your initial investment, and positions can become worthless in minutes if the market is moving against you. Many brokerages aggressively have promoted F&O trading strategies because it is going to generate higher brokerage revenue to them. Look at this SEBI study. SEBI study reveals that 93% of individual traders incurred losses in equity F&O segment between financial year 22 to 24. And average losses have exceeded 1.8 lakhs crore in 3 years. So don't fall for these quick money making options. Instead, try to build a long-term portfolio. Basically, F&O is designed for hedging purposes. So you should be using this under guidance of experienced traders who can understand the risk and mechanics involved. Even I don't trade in F&O. I'm just a long-term investor. That gives me peace of mind. Warren Buffett describes F&O as a weapon of mass destruction. One day you might think that, wow, I have made all the money in the stock market, but it can vanish in any minute. So try to avoid this F&O completely if you are not trained trader. Some people may ask, how can I bring initial capital for so-called long-term investing if I don't do F&O? I would say focus on your skill set. Focus on building, required skills and the career. So get better salary for the initial capital, but don't depend on F&O. So let's go for the second mistake now. That is as important as the first one, investing in penny stock. Penny stocks might seem attractive due to their low prices and potential for high percentage gains. But they are most of the time breeding grounds for market manipulation and scams. These stocks typically belong to companies with questionable financials and minimal public information, poor corporate governance standards. So the low liquidity in these penny stocks make them easy target for pump and dump schemes. Many investors lose their hard-earned money here because they focus solely on the stock price without understanding the business fundamentals. Remember, rupees 5 stock is not necessarily cheaper than 500 rupees stock. What matters here is the value that you're getting for the price that you're paying. So you need to understand a bit of fundamentals through, analysis of financial and business models. You have to understand the real value of the stock, not just the headline price. Remember, the vast majority of the penny stocks eventually have become worthless and sometimes even illiquid. So please be careful before investing. Now the third point, investing based on Telegram tips. The rise of social media had really led to the proliferation of self-proclaimed stock market experts on various platforms, including Telegram. So these channels often operate without any regulator oversight or SEBI registration. They basically lure investors by selectively showing the screenshots of the profitable trades while hiding the losses they have made. It creates an illusion of guaranteed returns. So these channels typically operate on pump and dump schemes where they actually accumulate the position in the low liquidity stocks before recommending them to the public or to the followers. Once they know that people started buying the stock and they see the price going up, these channel operators, they sell their holdings, causing the stocks to crash. Always remember, if someone had a foolproof way of making money in the stock market, they wouldn't be selling it on the Telegram. SEBI has taken actions on many people, but just think practically, it's really impossible to regulate all of the channels on the social media. You should be careful, so you should be avoiding this kind of tips. There is no way to, get rich quick schemes, right? You have to be the one who should exercise care and caution. If you really want to consult, go with a registered advisor. They're called as RIA, Registered Investment Advisor. They advise on which stocks to buy and what should be the asset allocation. Many people even come to me and ask, give me the stocks tips. But I'm not a SEBI registered RIA. I'm a MFT. So I can help you through mutual fund. I have license to advise on mutual fund investing. Mutual fund distributors are registered with AMFI, which is part of SEBI. I'm an overseas MFT. That means I can help you structure the goals using the mutual fund route. So if you are interested to invest in Indian markets and you are NRI, you can WhatsApp us to this number or email to info@keerthisfinfo.com. We would be really happy to assist you. If you want more details about our services, just visit my website www.keerthisfinfo.com. Now that's it. Let's go to the fourth mistake. Investing with borrowed money. I'll tell you, this is an atom bomb. Like I said before, trading on the margin might seem tempting as it allows you to take larger position with less money. Who doesn't want it, right? But it's a dangerous practice that can accelerate your losses. When you trade with borrowed money, that means taking loan from friend or bank. You're not just risking your capital, but also you are taking that debt in this picture. So debt needs to be repaid regardless of your trading outcome. The kind of margin trading often, this forces investors to do many wrong things under the pressure. When the positions start moving against you, margin calls can force you to sell at the worst possible time. Even if you don't want, you have to sell. So locking you in the loss that could be, probably if you were just doing it with your own money, it would be just notional loss or paper loss. So it leads to poor decision making and it makes you to deviate from your investment strategy. Just avoid this. Invest but don't trade. That too, if you want to trade, use your own capital, not the debt. Fifth mistake is not understanding intrinsic value of the stocks. This mistake is not just done by retail investors. Even institutional investors, professional fund managers, all are prone to this. Successful investing, it requires more than just buying the stocks at cheaper price or trending stocks. You need to understand fundamental analysis or some basic metrics like PE, ROC, debt level, cash flow. This metrics helps you to determine the stock's valuation, if it is overvalued or undervalued relative to its industry peers or its own historical valuation. Different stocks require different valuation approaches. For example, if it is a growth stock, it might command higher PE ratio because it has future potential, while value stocks might trade at lower multiple but offer stable cash flows. So understanding the sector dynamics, competitive advantage, management quality, it is really critical. You have to be making informed decision. Don't just buy stock because it's going up or it's trendy or others are buying it. A classic example is a case of many new age technology companies like Paytm that recommended PE ratios over 100 during their IPOs in 2021. Investors who have bought these stocks without understanding the business models or valuation metrics, they saw their investments drop by 60 to 70% when the market began valuing these companies based on actual earning. I know it's very difficult to get the intrinsic value right always, but by proper research, you will get hang of it. Try it. Now let's go to the next mistake. That's not focusing on portfolio diversification. It's our sixth point. See, concentration makes you rich, but diversification keeps you rich. What do you mean by this? Concentration means putting all your money in some selected stocks. See, Warren Buffett, Rakesh Jhunjhunwala were known for this. If you have high conviction or risk appetite, you can go for this kind of strategy. No problem. But if you're a beginner or your risk doesn't permit that, retail investor, then putting all your money in single one stock or sector can expose you to unnecessary risk. If that company or sector faces challenges, your entire portfolio could be severely impacted. It's gone. History is full of such examples where, seemingly invincible companies with the strongest balance sheet also faced downturn. They had unexpected difficulties. So a well-diversified portfolio should spread investment across different sectors, market caps, potentially even asset classes. This doesn't mean over-diversification. Holding 50-60 stocks in your portfolio doesn't make any sense. You can go for index fund, right? Instead, aim for meaningful diversification with 15 to 20 high-quality stocks. Spreading it in different sectors based on your risk appetite and investment goals. Now the last but not the least and my favorite one, seventh point, emotional decision making. One of the biggest mistake investors make is letting emotions to drive investment decisions. Fear and greed, they are the powerful emotions. Buying high and selling low is exactly opposite of what successful investor does. During market downturn, fear might push you to sell the quality stocks at loss, and during bull run, the greed might lead you to buy overvalued stocks. Successful investing requires a disciplined approach based on research and strategy, not on emotions. Create an investment plan that aligns with your goals and risk tolerance and stick to this regardless of the market noise. You should have that ability to ignore the noise. Remember, stock market is a tool for wealth creation over long term. It's not a casino for quick gain. Regular review and rebalancing of your portfolio should be based on fundamental change in macros, investment strategies, market sentiments, not based on the tips from unqualified sources. Let me tell you this. I still remember the market crash of March 2020. Our family portfolio was crashing 15 to 20% every day. In fact, even the whole Nifty was in the lower circuit at that time. It can scare any investor, right? So we were not exceptional. But at some point, we decided that we are going to hold on to it. We will not sell. In panic, we didn't sell. In fact, we started adding whatever money we had at that time. Look at this chart. From 2020 March to 2021 March, market had given more than 60% in Nifty level. Mid cap and small caps have doubled. Investors who panicked sold the quality stocks at that time in the bottom might have missed out on the remarkable recovery that followed. So those who had stayed invested like us in the fundamentally strong companies, even added more shares during the dip, saw their portfolio reaching new high within a year. During COVID, we learned our biggest lesson of a lifetime. Not to panic during the market fall, definitely it is a lesson, but the lesson actually is making money in stock market is 90% behavior and just 10% is your knowledge. So control your emotions. Stay invested long term in the stock market. That's the only way to create wealth in the stock market. If you're interested to know more about the behavior aspect of investing or money, just read a book called Psychology of Money. This is really a favorite book of mine. That's it for today. If you like this video, don't forget to subscribe this channel. We bring you more content every week. If you need any of our services also, please book an appointment or write to us at info@keerthisfinfo.com. See you next week with another video. Till then, bye-bye.